Welcome to the GSMC Financial News Podcast, the show that delves into the ups and downs of the stock market, changes in the economy, and news from the worlds of real estate and technology. From breaking news on the New York Stock Exchange, NASDAQ, or the overseas market, to updates on the bond market, if there's money to be made, we've got you covered. Hello and welcome to the GSMC Financial News Podcast, brought to you by the GSMC Podcast Network. I am your host, Sarah, and we are going to jump right in with what the stock market did today, Thursday, January 23rd, 2020. The Dow fell 26.18 points, or 0.09%. to end the day at 29,160. The S&P 500 climbed 0.11% to 3,325. The NASDAQ Composite advanced 0.20% to 9,402. Stocks closed well off their session lows as worries over the deadly coronavirus eased. So according to the World Health Organization, it is too early to declare a health emergency. The World Health Organization addressed the coronavirus outbreak, saying it was a bit too early to consider this event is a public health emergency of international concern. The major averages traded well off their lows on the back of that statement. However, the major averages failed to post substantial gains as the corporate earnings season continued. NBC Universal parent Comcast and Travelers posted better than expected results, but their stocks closed lower. Further confirmation that the coronavirus situation is not as critical as feared will keep stocks near record levels. Shares of American and United Airlines gained 5.42% and 1.85% respectively on the back of WHO's comments regarding the coronavirus. Biotechnology companies Gilead Sciences and Inovio Pharmaceuticals also gained 0.8% and 11.63% respectively. Speaking of those stocks, here are the stocks making the biggest moves pre-market. As mentioned, Comcast, Travelers, American Air, and more. Here is a little more information on those stocks. Comcast. The NBC Universal and CNBC parent reported quarterly earnings of 79 cents per share, 3 cents a share above estimates. Revenue came in above forecasts as well. The company said its cable division saw record quarterly net additions for customer relationships. Comcast also announced a 10% dividend increase. Procter & Gamble. The consumer products giant beat estimates by 5 cents a share with quarterly profit of $1.42 per share. The company also raised its full-year earnings outlook. Sales missed estimates for the first time in 5 quarters, however, hurt by a stronger dollar. Travelers. Travelers beat estimates by 3 cents a share with quarterly earnings of $3.32 per share, $3.32 per share. Revenue came in just above estimates. The insurance company saw net written premiums increase in all 3 business segments for the 12th consecutive quarter. American Airlines beat forecasts by a penny a share with adjusted quarterly earnings of $1.15 per share. Revenue was essentially in line with estimates. The airline said about 10,000 flights were canceled during the quarter due to the Boeing BA 737 MAX grounding. General Electric. Morgan Stanley upgraded GE to overweight from equal weight, and raised the price target to $14 per share. Morgan Stanley noted the risks from the power and long-term care businesses and from pension issues are declining. It also called GE's aviation business best in class. VF Corp. The parent of North Face and other apparel brands reported adjusted quarterly profit of $1.23 per share, 2 cents a share above estimates. Revenue came in below Wall Street forecasts, however, and VF lowered its full-year guidance amid weak demand for its Timberland brand. Southwest Airlines. The airline reported quarterly profit of $1.16 per share, excluding an item of 18 cents per share from profit-sharing plan contributions related to compensation from Boeing. That compared to a consensus estimate of $1.09 per share. CEO Gary Kelly said more 737 MAX-related schedule adjustments are likely to come. Revenue came in slightly above forecasts. Amazon.com asked a court to pause Microsoft's work on the Pentagon's JEDI contract, which Amazon maintains was unfairly awarded to Microsoft. PG&E struck a deal with creditors led by Elliott Management and PIMCO that will allow the utility to proceed with its reorganization plan. The creditors group had been pushing for a rival plan, but will now support PG&E's proposal. Texas Instruments reported quarterly profit of $1.11 per share, beating estimates by 9 cents a share. The chipmaker's revenue was also above Wall Street forecasts. The company forecast better than expected current quarter revenue as demand for microchips stabilizes. Ford will see a $2.2 billion pre-tax loss for the fourth quarter due to higher contributions to its employee pension plans. And finally, Kinder Morgan reported quarterly earnings of 26 cents per share, missing estimates by a penny a share. The pipeline operator's revenue also fell short of Wall Street forecasts as prices for natural gas and crude oil fell. Our top story today comes to us from CNBC. Investor Bill Miller doubles returns in 2019 and says stocks will rise even further in 2020. Investor Bill Miller came back with a bang in 2019, riding the stock market's relentless rally to record highs. He also thinks there may be more gains in 2020. Miller's firm, Miller Value Partners, posted a return of 119.5% last year, net of fees, he told investors in a January 15th letter. Those gains more than made up for the firm's 33.8% loss in 2018. Those returns also blew the broader market's gains out of the water. The S&P 500 rose 28.8% in 2019. Still, that was the index's best annual performance since 2013. Few, if any, predicted a strong stock market given how bad the fourth quarter of 2018 returns were. The result was the best stock market in years, Miller wrote. Stocks sold off sharply in the fourth quarter of 2018, battered by fears of a global economic slowdown and U.S.-China trade tensions. Wall Street's strong performance, including Miller Value Partners, was driven in large part by easier monetary policy from the Federal Reserve, along with easing tensions between China and the U.S. Miller also noted he kept his holdings intact throughout the final 3 months of 2019, which led to a fourth quarter return of roughly 60%. In the fourth quarter, we did our favorite thing to do in markets, nothing. No new names and no elimination of holdings from the portfolio. This doesn't happen as often as it probably should, Miller wrote. Miller, who beat the market for 15 straight years while working at Legg Mason, added the market can yield more gains this year. To be sure, it may not be as straightforward as 2019. Stocks will not move in a straight line higher even if the bull market continues in 2020, as I believe it will, said Miller. Setbacks and corrections should be expected, but unless something causes the economy to tip into recession and earnings and cash flows to decline, which I do not expect even if the geopolitical situation gets grimmer, then the path of least resistance for stocks remains as has been for a decade, which is higher. We are going to go ahead and take our first break of the podcast. When we come back, we'll be talking about 23andMe laying off 100 people as DNA test sales decline. As part of that first break, this week we take a look at what is considered by many to be the next extreme high-growth sector. Quickly becoming part of all consumers' lives and beginning to impact almost every major industry sector is virtual reality, augmented reality. Predicted to bring us the most disruptive technology since the cell phone and impacting a wide array of core industries, including entertainment, healthcare, education, retail, military defense, marketing, manufacturing, and media. Nearly every major player in the technology space have invested heavily in VR/AR. This includes the top social media company Facebook's purchase of Oculus for $2 billion, Their firm commitment to focus on virtual reality recently launched Facebook 360, which allows all 2.2 billion and climbing active Facebook users to experience and share virtual reality content. YouTube has also invested deeply in VR, now prioritizing VR content over other content to its 1.3 billion active users. And it does not stop with social media, as Samsung, the largest manufacturer of cell phones worldwide, has over 1 million users per month on its Gear VR headsets. Sony PlayStation launched VR games on its PlayStation 4 console, as did Microsoft on its Xbox One platform. Other standout tech companies invested include Google, IBM, Intel, HP, Foxconn, and other smaller but notable companies such as LG and HTC. In fact, 8 of the top 10 tech companies in the world are invested in VR/AR. Whether you've strapped on your favorite VR headset or just seen one of those 360 videos on YouTube or Facebook, chances are you've already sampled virtual reality. From entertainment to educational applications, VR has finally made the transition from science fiction to everyday life, and it is set to massively expand. Per projections from Greenlight Insights, VR is set to reach 171 million active VR users, generating nearly $121 billion in sales in just a few short years. Analysts at top brokerage firms such as Goldman Sachs are aggressively recommending virtual reality stocks, likening the opportunity to the advent of the television. Piper Jaffray described virtual reality as the next mega tech theme, going as far as comparing the state of virtual reality today to that of mobile phones 15 years ago. Investing in high growth trends is proven to be one of the best ways to build wealth. VR/AR can be considered to be the highest growth sector we have seen in many years and is the focus of publicly traded market giants such as Google, Facebook, Microsoft, and Sony, as well as smaller public companies such as innovative content and technology leader Realtime, VR trading as RLTR. Do your research now on virtual reality. Are you a business owner? Someone interested in the latest news that might affect your business? Then check out the GSMC Business News Podcast, a show dedicated to keeping you up to date on all things concerning business, technology, and the stock market. Get a head start on the day as we keep you updated on the latest goings-on Wall Street, money, jobs, and technology. The GSMC Business News Podcast has you covered. Welcome back to the GSMC Financial News Podcast. Before the break, we were talking about investor Bill Miller and his pretty stellar 2019 and the fact that he thinks 2020 has potential to be just as good. As I mentioned, we are now moving on to the story of 23andMe laying off 100 people, which is about 14% of its staff. This was announced on Thursday in wake of declining sales. The layoffs include the operations team, which were focused on the company's growth and scaling efforts, as well as other teams. In the coming months, the company plans to tighten its focus on the direct-to-consumer business and its therapeutics arm while scaling back its clinical studies arm. CEO Ann Wojcicki told CNBC she's been, quote, surprised to see the market starting to turn. Wojcicki has theories, but she doesn't have clear proof for why consumers are shying away from getting tests that reveal their percentage of Irish heritage, propensity for a favorite ice cream flavor, or whether they have a limited set of variants that are associated with breast cancer. Either way, she notes, she's downsizing because it's, quote, what the market is ready for. End quote. She also says this has been slow and painful for us. She notes that privacy could be a factor. Fears about people's DNA ending up in the wrong hands might have been heightened in the aftermath of the Golden State Killer case. Criminal investigations honed in on a suspect involved in decades-old rapes and murders by running DNA found at the scene through a free online database where anyone who got their DNA tested through a company like 23andMe could upload it. A suspect was found because a distant relative had shared their genetic information, showing how DNA data, unlike other kinds of data, is unique because it's linked to and potentially exposes information about family members. Wojcicki acknowledges that privacy is top of mind, both for consumers and her executive team. She said the company hired a new chief security officer who previously ran security at Okta. They did that earlier this week. She is quoted as saying, "I think the tech world needs to own this better to communicate privacy standards to build trust. I want to jump in and really own it." Wojcicki said another factor could be that people fear an economic downturn and they don't want to spend a few $100s on a genetic test. That might make it expensive for 23andMe to acquire customers via social media platforms like Facebook if the early adopters have already bought tests and the next potential batch of users are reluctant to spend. 23andMe has seen its ups and downs over the years. The company raised ample venture capital, $786 million, according to Crunchbase, and Wojcicki said that to fuel growth, including by hiring a team to acquire new customers for its tests and to strike deals with both pharmaceutical companies like GlaxoSmithKline and academic research groups. But the FDA conducted a regulatory probe in 2013 after 23andMe marketed a health test directly to consumers. The company repaired its relationship with the FDA and resumed sales of both its ancestry and health tests in 2015. What followed was a period of hypergrowth, which involved the company ballooning to 700 people. And it seemed to be working. Sales of DNA tests were growing until they weren't, which started sometime in 2019. The first clear signs of a slowdown in the space came last summer when Francis D'Souza, chief executive of Illumina, maker of DNA sequencing machines, noted in its earnings call that the entire segment was down. D'Souza didn't share an explanation, but said his company is taking a, quote, cautious view of the market for ancestry and health tests. Illumina's customers include Ancestry and 23andMe. Other companies in the sector have also pivoted or struggled, including Veritas Genetics, which shuttered its U.S. operations late last year. Meanwhile, Color Genomics raised capital in recent months after focusing on the enterprise market, which involves selling to companies, not just consumers. It has relationships with Jefferson Health, a major hospital chain, and Apple, among others. Investors in 23andMe include Google parent company Alphabet, where Wojcicki's sister Susan is the CEO of YouTube, plus GlaxoSmithKline and Sequoia Capital, among others. Our next story is about Apple's new Connected Gyms program, which gives you benefits for working out with their Apple Watch. On Thursday, they announced its new Apple Watch Connected Gym initiative, a new series of partnerships with fitness facilities that make it easier for people who own Apple Watches to track workouts, buy stuff, and earn rewards for working out. It's Apple's latest fitness expansion, helping to build an entire ecosystem around the Apple Watch and providing owners with more places to use it to improve their fitness tracking. It creates yet another reason for people to buy Apple Watches. If you're trying to work out, why not get a watch that works seamlessly with the gym you're joining? And it helps keep gym customers through reward-based initiatives. It also adds a streamlined tech layer on top of gyms, which often have various third-party technologies that don't always talk to the fitness wearables people have. 4 gyms are part of the program, with select locations going live on Thursday, today. Additional fitness facilities will also join the program in the future, Apple said. Launch partners are Basecamp Fitness, Orange Theory, YMCA, and Crunch Fitness. It's free for gyms to participate so long as they meet Apple's criteria. We are going to take our second break of the podcast, but when we come back, we will talk about what you need to know about this Apple Connected Gym program. Stay tuned. You're listening to the GSMC Financial News Podcast, and I will be right back. As part of that break, I want to talk to you about Birch Gold Group. In 2008, the U.S. national debt was $10 trillion. Today, it's over $23 trillion, and it's rising like a hockey stick. If you don't think we're sitting on a house of cards, you're living with your head in the sand. But since you're listening to this podcast, you're clearly smarter than the average American. So what's your plan? Can you afford another hit to your retirement like the last downturn when the S&P dropped 50%? As one of the top dealers of physical precious metals in the United States, Birch Gold Group helps Americans diversify their savings with gold and silver. Customers can purchase for physical possession or convert a portion of their IRA or 401k into an IRA backed by physical precious metals. Birch Gold Group specializes in gold IRAs. Gold is a safe haven against uncertainty. You can hedge against inflation and hedge against uncertainty and instability with precious metals. Right now, thanks to a little-known IRS tax law, you can even move your IRA or eligible 401k into an IRA backed by physical gold and silver. It's perfect for those who want to protect their hard-earned retirement savings from any future geopolitical uncertainty. Look back historically. When the bottom falls out of everything else, gold tends to safeguard savings. Birch Gold Group has thousands of satisfied customers, countless 5-star reviews, and an A+ rating with the Better Business Bureau. Contact Birch Gold Group to request a free info kit on physical precious metals. See if diversifying into gold and silver makes sense for you. This comprehensive 20-page kit reveals how gold and silver can protect your savings and how you can legally move your IRA or 401k out of risky stocks and bonds and into a precious metal IRA. To get your no-cost, no-obligation kit, go to birchgold.com/finance. That's BIRCH gold.com/finance. Do you work in the world of marketing and advertising? Are you a media buyer or the owner of an agency? Have you been looking for a podcast to help stay on top of all the goings-on of those worlds? The GSMC Marketing News Podcast is dedicated to keeping you up to date on all things concerning marketing and advertising. Get the latest marketing news, from what major businesses have planned for the coming year, to the newest trends in advertising, from podcasts, digital and streaming, to the old standbys of radio, television, and billboards. The GSMC Marketing News Podcast has you covered, whether you're a marketing agent or a business trying to expand your brand. Welcome back to the GSMC Financial News Podcast. Before the break, we were talking about Apple connected gyms. And if you own an Apple Watch, you might want to participate in one of these programs. The Apple Watch connected platform includes 4 tiers that must be supported by a gym that participates in the program. The requirements are: an Apple Watch connected gym has to have an iPhone and Apple Watch app that lets people track their fitness, see classes, and log in at the gym. Gyms have to offer some sort of option for Apple Watch owners to earn with Apple Watch. For example, Crunch will give you $3 to $4 in weekly credit if you meet certain goals, like working out a certain amount of time per month. The credits apply to the following month's bill. You can hit those goals either by working out inside or outside of the gym. Orange Theory will offer gift cards to Apple and Nike for hitting certain goals. Basecamp Fitness will give you an Apple Watch Series 5 GPS model that you can pay off by participating in 3 classes a week for an entire year. At the YMCA, your workouts will go toward providing free classes for children like swim lessons. The gym has to accept Apple Pay. That means you can leave your phone in the car and just use your Apple Watch to buy stuff like water, food, or other goods only using your wrist. A fourth tier requires gym kit on cardio machines, unless it's a studio like Orange Theory where people exclusively get on and off equipment frequently during a studio-style workout class. These are special machines that will automatically sync your workouts to your Apple Watch, providing more information than the Apple Watch might be able to get on its own. For example, a stair climber will give you a more accurate representation on floors you've climbed, since the sensors inside the Apple Watch can only track actual flights of stairs as you change altitude. There's a benefit to gyms for adding Apple Watch Connected. They will see it as gyms see it, as a way to help keep customer turnover low. Crunch Signature CEO Keith Wartz said, I'm confident this will help member retention and keep members active and engaged. He said during a press briefing at a Crunch Fitness gym on Wednesday. Wartz also addressed privacy concerns. He said that members will opt in to the program and that the gym, quote, complies with every privacy law there is. Crunch Fitness won't use the data from Apple Watches to see which machines people use most, for example. There are different sensors already built into the machines that already do that, though. None of the data is shared with Apple either, Apple said. Basecamp will launch Apple Watch Connect to all of its clubs over the next year. The YMCA will start with its Greater Twin Cities location this week, followed by 22 additional YMCA branches in the coming weeks before expanding further. Crunch Fitness is launching Apple Watch Connected in 2 Manhattan gyms this week, with more coming. Finally, Orange Theory will deploy it in all of its U.S. facilities in 2020, starting with 2 Manhattan locations today, and then going from there. So if you are an Apple Watch owner or you've been curious, this might be the time to try that out. And if you've been thinking about, that New Year's resolution of joining a gym, maybe these two things will now combine and encourage you to work out. Our final story of the podcast is that former Wells Fargo CEO John Stumpf has been barred from industry to pay $17.5 million for sales scandal. The U.S. government announced today that former Wells Fargo CEO John Stumpf has been banned from ever working at a bank again and will pay that $17.5 million for the scandal in which millions of fake accounts were set up to meet sales quotas. The notice from the Office of the Comptroller of the Currency said the regulator plans to target other individuals, including former executives, for their roles in the scandals. The actions announced by the OCC today reinforce the agency's expectations that management and employees of national banks and federal savings associations provide fair access to financial services, treat customers fairly, and comply with applicable laws and regulations, Comptroller of the Currency Joseph Otting said. In addition to the $17.5 million fine, Stumpf's settlement declares he shall not participate in any manner at any bank regulated by the OCC or participate or attempt to participate in a bank's corporate board votes. The OCC also said the former head of Wells Fargo's community bank unit, Carrie Tolstedt, is still fighting the allegations against her. The regulator also seeks a prohibition order and $25 million from Tolstedt. The nation's fourth largest bank, Wells Fargo, has remained muddled in restructuring and regulatory reforms since 2016, stemming from the scandals at its consumer-facing community bank. The fallout has had lasting consequences for the San Francisco-based bank, once a rapidly growing lender with eye-popping profits. In recent years, however, Wells has stalled between stagnant revenues and an urgent need to cut costs. In light of the announcement, current Wells Fargo CEO Charlie Scharf told the bank's employees that, quote, the OCC's actions are consistent with my belief that we should hold ourselves and individuals accountable. They are also consistent with our belief that significant parts of the operating model of our community bank were flawed, he added. At the time of the sales practice issues, the company did not have in place the appropriate people, structure, processes, controls, or culture to prevent the inappropriate conduct. Scharf added that Wells Fargo will not make any remaining compensation payments that may be owed to these individuals while we review the filings. So that is it for our financial news podcast for today. If you are a fan of this podcast, please do subscribe to it on all of the platforms that you listen to podcasts on. Go ahead and give us a nice review, follow us on social media, do all of those wonderful things that help us to get this podcast out to more people. Hope you are having a wonderful day and that you've got something fun going on for the weekend. Please join us again for the next edition of the GSMC Financial News Podcast, brought to you by the GSMC Podcast Network. You've been listening to the GSMC Financial News Podcast, part of the GSMC Podcast Network. You can find this show and others like it at www.gsmcpodcast.com. Download our podcasts on Apple Podcasts, Stitcher, SoundCloud, and Google Play. Just type GSMC into your favorite podcast app to find all of the shows from the GSMC Podcast Network. From movies to music, from sports to entertainment, from business news to weird news. Please subscribe to the podcast and follow us on Twitter and Facebook. Thank you, and we hope you've enjoyed today's podcast.